Welcome to Griffonomics.
Thanks for having me back. It's good to be here.
Yeah, today we are opening up a file that, honestly, on the surface, it sounds like the most boring topic on earth.
Oh, absolutely the most boring.
Right. We are talking about medical billing.
Yeah.
But, once you actually peel back that first layer, you realize we aren't really talking about billing at all.
Oh, not at all.
We are talking about this massive $500 billion leak in the U.S. economy.
It's a leak that is just actively draining resources right out of patient care.
Exactly. So for you listening, we're looking at the absolute chaos of the U.S. healthcare administrative system.
Chaos is the right word.
It's mountains of paperwork, it's denied claims, armies of people just faxing things back and forth.
Faxing in the 2020s.
Right. And it's a mess that costs the system roughly $450 billion every single year.
Which is just a staggering number to even wrap your head around.
I mean, that is almost the GDP of Austria, just totally wasted on friction.
Yeah, and that right there is exactly why we're doing this deep dive today on a company called Waystar.
Ticker symbol WAY.
Right.
Now, usually when we look at software companies, we're looking for the next big shiny thing,
It's a consumer app, the new device.
Yeah. But with Waystar, looking at the stack of sources we have today, and we've got their FY 2025 earnings reports, transcript calls with their CEO, Matt Hawkins, the 10K filings, plus some really detailed analyst reports from Red Fox and Baron Capital.
It's a huge stack of data.
It is. And the story here isn't about a shiny new toy. It's really about plumbing.
It's critical infrastructure,
Yeah.
but it's also about a fundamental shift in how that infrastructure actually works.
Okay, lay that out for us.
So we are looking at this transition from a legacy clearinghouse model, which is basically just a digital post office for medical bills.
Right.
Moving from that to what they are calling the autonomous revenue cycle.
Now, autonomous revenue cycle, that phrase sounds a lot like marketing fluff.
It really does.
But that is our mission for this deep dive. We need to test that claim.
Exactly.
We need to move past the AI hype. Because let's face it, every CEO on Earth right now says they have AI.
They put it on every slide in the deck.
Right. We need to look at the actual ROI reality, the hard numbers.
And to do that, we have to break down this merger of financial data with clinical data.
Which means looking closely at their massive Iodine acquisition.
Yes, that is the linchpin of the whole strategy.
And finally, we have to look at the money. I mean, for you listening, if you invest in software, you care about financials. And this is a company operating at the rule of 50.
Which is incredibly rare air in the software world.
It separates the pretenders from the contenders.
It really does.
So, let's set the scene before we get into the billions of dollars here. I was actually thinking about this on my drive-in today.
Okay.
If I go buy a coffee, I tap my card, the machine beeps, I get my coffee.
Transaction complete.
3 seconds. It's totally seamless. But if I go to the doctor, I hand them a physical card, they type for 10 minutes, I wait 3 weeks, I get a letter saying I owe $500.
Yep.
Then a week later, another letter comes saying, oh, actually, you owe $20.
Or nothing at all.
Right. And then somehow 6 months later, a collections agency is calling me over an unpaid $15.
It's a nightmare.
So why? Why is healthcare payment so incredibly broken compared to just buying a latte?
Well, it comes down to a fundamental misalignment of incentives.
So
When you buy that coffee, you and the barista had the exact same goal.
exchange money for caffeine immediately.
Exactly.
Yeah.
But in healthcare, you have this triangle of conflict.
Okay, let's break down the players in this triangle.
First, you have the provider. That's the doctor or the hospital.
Right.
They want to get paid as much as possible, as fast as possible, for the care they just delivered.
Makes sense.
They are heavily incentivized to bill for everything they did.
Sure.
Then, on the other side, you have the payer, the insurance company.
The ones with the money.
Right. And their entire business model depends on not overpaying.
They want to keep the money.
Exactly. So they have these thousands of incredibly complex rules designed to verify necessity and basically block waste.
Their default setting is skepticism.
Verify before paying. Always.
And then there's the third point of the triangle.
The patient, you, stuck right in the middle.
Usually totally confused about what our plan actually covers.
Just always confused. So historically, the only way to resolve this massive three-way conflict was just brute force.
Humans.
Armies of humans.
The basement dwellers.
Figuratively, yes.
Yeah.
You have thousands of people sitting in hospital basements, manually checking billing codes against massive manuals,
Faxing medical records to insurance adjusters.
sitting on hold with the insurance company for 2 hours just to argue over whether a specific MRI was quote-unquote medically necessary.
It's a process totally defined by human error and just massive manual friction.
And that friction is exactly where Waystar enters the chat. They call themselves the linchpin.
The linchpin. I like that. So they sit in the middle.
It's a very fair assessment. They are a cloud-based software platform that sits right in the dead center of that conflicting triangle.
Connecting everyone.
Right. They connect the providers to the payers. And the scale we are talking about here is just difficult to overstate.
Give us the numbers.
We are talking about a network that connects over 1 million providers.
1 million. That's almost every doctor you could think of.
That's massive. And they process 7.5 billion transactions annually.
Billion with a B.
Billion with a B. That represents about $2.4 trillion in gross claims.
2.4 trillion. That's a huge chunk of the economy.
To put that in perspective for you, their software touches the data of approximately 60% of the entire U.S. patient population.
So if I went to a doctor anywhere in America last year, there's a better than coin flip chance that Waystar processed my data.
Precisely. You probably never saw their name, but they were there.
And that scale, that has to be critical for the AI piece we're going to talk about later.
Oh, absolutely. In the age of AI, data is oxygen.
Right.
If you don't have the sheer volume of data, you can't train the models.
You're just guessing.
Right. But before we get to the AI, we really need to understand the business model. How do they actually make money from moving all this data around?
Yeah, let's look at the revenue segments here, because reading through the 10K, it's not just a monolith. They have this interesting 55-45 split.
Right.
So let's start with the 55%, the subscription revenue.
So this segment is primarily driven by what the industry calls the ambulatory market.
Ambulatory. That's basically industry speak for non-hospital, right? Like you walk in, you walk out.
Exactly. Think of your local physician groups, specialist offices, the dermatologist down the street.
Small to medium practices.
Right, maybe a group of 10 to 50 doctors operating together.
Okay, so how does Waystar charge them?
For these clients, Waystar charges a predictable monthly per provider fee.
Ah, okay. Classic software as a service.
SaaS. Exactly, classic SaaS.
Yeah.
And for investors, this is beautiful because it creates the floor for the stock.
It's the safety net.
It's highly stable, it's recurring, and it gives management incredible visibility.
Because you know, essentially, what you're going to make in January before the month even starts.
Because those contracts are locked in.
Yeah.
The doctors have to pay the fee to keep the software running.
Okay, so that is the stable, boring base. But then there's the other 45%, the volume-based revenue.
Right.
This one seems a bit more dynamic, a little more volatile.
It is. This segment targets the massive health systems.
The big boys.
The giants. We are talking about places like, well, 16 of the top 20 U.S. News Best hospitals use Waystar.
Wow.
And for these massive enterprise clients, the revenue isn't just a flat monthly fee. It's actually tied to transaction counts and patient payment take rates.
Okay, so let me make sure I understand this. The more patients that get sick and go to the hospital, the more money Waystar makes.
In a crude sense, yes. It is directly tied to healthcare utilization.
Fascinating.
And this actually introduces a really interesting element of seasonality that anyone following this company really needs to watch.
I saw this in the analyst notes, the deductible reset phenomenon.
Yes.
Explain how this plays out across the calendar year, because I think a lot of people experience this but don't think about the macro effect.
Right. So think about Q1, January, February, March.
Okay.
For almost everyone in the U.S., their health insurance deductibles reset to zero on January 1st.
Right. Happy New Year. You owe the doctor full price again.
Exactly. Suddenly, patients are on the hook for the first $2,000 or maybe $5,000 of their care out of their own pocket.
Yep.
Now, when patients realize they have to pay that out of pocket, two things happen systemically.
Okay.
First, hospital collection rates drop significantly because people simply don't have the cash lying around to pay a $3,000 bill in January.
They delay paying it.
Right. And second, elective procedures often get postponed.
Oh, that makes total sense. Nobody wants to get their knee replacement done in January if they know they have to pay the full deductible up front.
Exactly. They wait until later in the year when they might have chipped away at that deductible through regular doctor visits.
So they push it to the fall.
Right. So Q1 is typically the absolute slowest quarter for patient payments and transaction volume.
And then it ramps up.
As the year progresses into Q2, Q3, and especially Q4, People hit their deductibles.
The insurance kicks in.
Insurance takes over, volume ramps up, and Waystar's revenue in this volume-based segment just accelerates.
It creates a totally predictable annual wave.
Yes, happens every single year.
But, regardless of the season, one thing that jumped out at me from the FY 2025 numbers, once these hospitals sign up for Waystar, they just do not leave.
They stay forever.
The retention metrics in these reports are wild.
They are truly elite. Let's look at gross retention. It sits at 97%.
97%. Now, for the listeners who maybe don't analyze SaaS companies all day, in enterprise software, anything above 90% is considered very strong.
Right. 97% is basically unheard of. It means that once a massive hospital system goes through the absolute pain of installing the software, training their staff, wiring it into their server.
You almost never rip it out.
Never. The switching costs are just too high.
It is incredibly sticky.
Extremely sticky. And then you look at their net revenue retention, the NRR.
Right, NRR.
For FY 2025, it was 112%.
Okay, break that down.
That means even if Waystar fired their entire sales team tomorrow and didn't sign a single new customer all year, their revenue would still organically grow by 12%.
Just because their existing customers are spending more money with them every single year.
Exactly.
Now, does that 12% growth just come from jacking up the prices?
Part of it, sure. They do have annual price escalators built into these long-term contracts, usually around 3 to 4% to cover inflation.
But that leaves another 8% of growth to account for.
Right. The real engine driving that NRR is cross-selling.
Ah, land and expand.
Exactly. Waystar has a massive suite of products. They get a hospital in the door just to do basic claims processing.
The basic plumbing.
Right. But then a year later, they go back and say, hey, we see you're struggling to collect from patients. Why don't you buy our patient payment portal software?
And the hospital says yes because it's already integrated.
Exactly. And then the next year, they sell them the prior authorization tool. They just constantly expand their footprint inside the hospital's tech stack.
Okay, so we have a massive, incredibly sticky business that is processing trillions in claims growing from within.
Yes.
But the real reason we are doing this deep dive today, the reason this is a timely topic, isn't just because they're a very solid billing company.
No, it's about what's coming next.
It's because of a very specific, aggressive, strategic move they made recently, the acquisition of Iodine software.
This right here is the inflection point for the whole company.
October 1st, 2025, Waystar drops roughly $1.25 billion to buy Iodine.
A huge deal.
Now, I have to admit, when I first saw the word iodine in the filings, I just thought of the brown antiseptic they put on cuts.
Right, the stuff in the first aid kit.
But this company is clearly doing something very different. Why was this such a massive deal for Waystar?
To really understand the Iodine deal, you have to understand the gap in the revenue cycle.
Okay, let's walk through the cycle.
So we usually talk about the front end and the back end.
The front end being when I walk into the clinic and hand the receptionist my insurance card to make sure I'm covered.
Exactly.
Yeah.
Eligibility verification. Checking if you have insurance before you walk in the door.
And the back end.
That's sending the actual bill to the insurance company after you leave the hospital.
Front and back. Standard stuff. Waystar already did that.
Right. But there's always been a massive gap right in the middle. They call it the mid-cycle.
The mid-cycle. What happens there?
The mid-cycle is where the actual clinical reality happens.
Huh?
Is where the doctor writes their notes.
A medical chart.
Right. They are documenting what happened during the surgery or what they discussed during the office visit.
And knowing doctors, those notes are probably not written in perfect machine-readable code.
Hardly. Clinical documentation is notoriously messy.
I can imagine.
It's unstructured text. It's highly nuanced. It's full of medical jargon, abbreviations, and it is very often rushed because doctors are seeing 30 patients a day.
Right. They are just dictating on the fly.
Exactly. But here is the massive problem. The billing department in the basement needs specific, rigid, alphanumeric codes to send to the insurance company.
They don't want a paragraph. They want a code.
Right. And if the codes on the final bill do not perfectly match the clinical evidence buried in those messy notes,
The claim gets denied.
immediately denied. The insurance company says you billed us for severe sepsis, but the doctor's notes just say the patient had a fever and an infection. Denied.
Wow. So the mid-cycle is really the translation layer between medicine and money.
Exactly. And that translation layer is exactly what Iodine software does.
So they fix the gap.
They use highly tuned AI to read those messy clinical notes in real time.
Okay, so before this $1.25 billion acquisition, Waystar just had the financial data.
Right. They had the 7.5 billion transactions. They knew that a claim was denied.
They saw the rejection letter from Aetna.
Right. But they didn't always know why it was denied from a clinical perspective because they couldn't see the doctor's notes.
They didn't have the medical chart to prove the insurance company was wrong.
Precisely. Now enter Iodine. Iodine has the clinical data.
And at what scale?
Massive scale.
Right.
They process 160 million patient encounters, and they cover 1 in 3 U.S. hospital discharges.
1 in 3?
Yes. So by acquiring Iodine, Waystar basically married the financial data with the clinical data.
The marriage of money and medicine.
It really is. And this leads to what CEO Matt Hawkins in the industry call the holy grail of revenue cycle management.
Which is?
The perfect, undeniable claim.
Okay, that sounds very ambitious. Undeniable.
It is ambitious, but when you look at the tech, the logic holds up.
Walk me through how it actually works in practice.
Okay, imagine a doctor finishes a complex surgery and writes their notes. Instead of just sending that to a human biller to guess the codes, Iodine's AI analyzes the clinical notes instantly.
Okay.
And because it's integrated with Waystar's historical denial data, it can predict before anyone even hits send that the insurance company is going to deny this claim.
It knows the future.
Basically, it knows that Aetna always denies this specific code unless the doctor explicitly uses the word acute in paragraph 3 of the chart.
Wow.
So the system flags it immediately. It tells the doctor or the biller, hey, you missed a specific documentation requirement. Fix it now.
So you don't send a doomed claim and wait 30 days to find out it failed.
Exactly. You fix it on day 1. You send a perfect claim.
That is fascinating. It's basically like a spell check, but for million-dollar hospital bills.
That's a great analogy.
Yeah.
And for investors, this isn't just strategic fluff. There are hard financial synergies here.
The Red Fox report mentioned some numbers on that.
Yeah, they expect $14 million in hard cost synergies in 2026 alone, just by combining these teams. It was immediately accretive to Waystar's margins.
So they've completely closed the loop. They have the front door, the back door, and now they own the messy middle.
They own the whole cycle.
But let's shift gears a little bit to the actual technology making all of this happen. Because look, AI is a buzzword that we hear in every single earnings call from every single company right now.
Oh, it's the flavor of the decade.
It really is. We have AI, please buy our stock.
Right.
But Waystar seems to be making a really distinct point in these transcripts. They're distinguishing between what they call generative AI and agentic AI.
Yes.
The word agentic just kept popping up everywhere in the CEO's commentary. What is the actual difference here?
This is a really critical distinction for anyone investing in software today to understand.
Break it down.
Generative AI, which is like the chatbots most people use on their phones, it creates content.
Right. It writes a poem or it summarizes a long email.
Exactly. But it's fundamentally passive. It waits for you to ask it a question, and then it gives you text back.
It talks to you.
Right. Agentic AI is different. It performs tasks. It has agency.
Agency, meaning it acts on its own.
Yes. It doesn't just flag a mistake and say, hey, human, look at this. It actually fixes the mistake.
Yeah.
It acts like a digital employee.
And Waystar rolled this out recently.
They launched these agentic AI capabilities officially in January 2026 under the name AltitudeAI.
AltitudeAI. Okay, can you give me a real-world example of this agent in action? How does it act like an employee?
Sure. Let's look at a denial appeal. This is a huge pain point for hospitals.
When the insurance says no and the hospital has to fight back.
Exactly. In the old world, the pre-agent world, if a claim was denied, a human being had to open the physical file.
Okay.
They had to read the cryptic denial code. Then they had to look up the patient's medical record in a different system.
Right.
Then they had to sit down and write a custom letter arguing why the insurance company was wrong and should pay.
And every insurance company probably wants a different format.
Exactly. Then they attach all the medical documents and they fax it or mail it back to the payer.
Honestly, that sounds exhausting.
It's terrible. And it took about 38 hours of cycle time, on average, to generate a single appeal package.
38 hours from denial to appeal.
Right. Waystar's AltitudeAI, their agentic platform, reduced that time to 2 hours.
From 38 hours to 2 hours.
Yeah.
I mean, that is a total order of magnitude shift.
It changes the entire math of the billing department.
Yeah.
And here is the truly agentic part of it.
Yeah.
The AI doesn't just pop up an alert saying you should appeal this. It autonomously drafts the appeal letter itself.
On its own.
Yes. It uses a proprietary library of over 1,100 payer-specific templates.
Wow.
It knows exactly what Aetna wants to see versus what Blue Cross wants to see in Ohio versus Texas.
It customizes the fight.
Right. And it pulls the relevant clinical data thanks to the Iodine acquisition and pre-populates the entire correction request.
So what does the human actually do?
In many cases, the human just has to quickly review it and click sign.
That's incredible.
Waystar reported that this cut manual chart review workloads across their clients by 40%.
That is a massive productivity boost for these hospitals. But I always want to know, does it actually save hard dollars? Or is it just cool tech that makes people's lives a little easier?
No, the ROI numbers they provided are surprisingly concrete.
Let's hear them.
In 2025, AltitudeAI prevented $15.5 billion in denied claims.
$15.5 billion.
That is money that providers would have likely just written off as a loss, or they would have spent months and thousands of labor hours fighting for.
$15.5 billion is not a rounding error. That's real money staying in the healthcare system.
No, it's huge. And look at another area, prior authorizations.
Oh, the absolute worst. That's the dreaded process where a doctor has to literally ask an insurance company for permission to give you a specific drug or order an MRI.
Right, it delays patient care all the time.
It's awful.
Well, Waystar's AI has achieved a 70% reduction in the time hospital staff spends on prior authorizations.
70% less time.
And an 85% auto-approval rate, meaning the AI submits the request so perfectly that the insurance company system just automatically approves it without a human reviewing it.
Because it knows exactly what the algorithm wants to see.
Precisely. And the market is absolutely responding to this ROI.
Are they actually buying it?
Oh, absolutely.
Oh.
This isn't just a shiny feature to talk about at conferences. It is actively driving sales.
What do the bookings look like?
They reported that 30 to 35% of all new bookings in 2025 were explicitly driven by these AI capabilities.
So 1 out of every 3 new dollars coming the doors because hospitals specifically want these AI agents.
Yes, they are buying Waystar specifically to get access to AltitudeAI.
Okay, so we've established they have great tech, and it's making real money. But here is the question I always have to ask when we talk about vertical software companies that are touting AI.
Right, the big tech question.
Exactly. Why can't Google or Microsoft or OpenAI just steal this? I mean, Google has Gemini, they have infinite compute power, they have billions in R&D. Why can't a tech giant just build a quote-unquote healthcare billing bot tomorrow and completely wipe Waystar off the map?
It's the multi-billion-dollar question, and it's exactly what the short sellers always point to.
So what's the defense?
The answer lies entirely in the data moat.
Okay, let's unpack this moat.
Think about generic large language models, a standard ChatGPT or Claude or Gemini.
Right, the ones we all use.
They are incredibly smart, but they are trained on the open internet.
Right, they read Wikipedia.
They know everything about Wikipedia. They've read all of Reddit. They know all of Shakespeare.
Sure.
But they do absolutely not know why a specific payer in Ohio denied a specific cardiology claim yesterday afternoon.
Because that data isn't on the internet.
Exactly.
Yeah.
They don't have the private transactional data.
Okay.
And without that data, the AI is useless in this specific application.
So Waystar has a monopoly on this specific data.
They have what analysts call a closed-loop advantage.
Closed loop, meaning they see the whole cycle.
Right. Waystar sees the initial claim go out.
Right.
Then they see the exact denial code come back from the payer.
Yeah.
Then they see the appeal package that gets created. And finally, they see the exact dollar amount of the final payment.
So the AI gets to learn from the final result.
It's a continuous closed feedback loop. Every single time a claim gets denied or paid, the AI gets slightly smarter about how to handle the next one.
And with 7.5 billion transactions a year.
Exactly. They are generating a proprietary training set every single day that no Silicon Valley startup and no generic tech giant can replicate.
Because you can't just scrape this data from the web.
No. It is highly proprietary, it's incredibly messy, and most importantly, it's heavily protected by high-power regulations.
It's legally locked inside their system.
Right. It's a massive moat.
Well, what about the software integration piece? Because you mentioned earlier they connect everyone. Even if a startup got the data, wouldn't they have to plug into the hospital?
Yes, and this is what I call the integration nightmare.
The nightmare.
For a competitor, yes. It is, frankly, Waystar's best, most impenetrable defense.
Why is it so hard?
Because you have to remember, healthcare IT is incredibly old and fragmented.
It's not all just one shiny cloud system.
Far from it. You have thousands of hospitals running software that was installed in the 90s, the 2000s. You have dozens of different vendors, different versions, massive custom patches,
It's spaghetti code?
complete spaghetti. Now, Waystar, over the last 2 decades, has painstakingly built direct integrations with over 500 different electronic health record and practice management systems.
500 different systems.
Yes, from the massive Epics and Cerners down to some niche software used only by rural dentists.
Wow.
So if a competitor wanted to displace Waystar, they wouldn't just need to build a better AI bot.
Right.
They would literally need to go out, negotiate contracts, build secure data pipelines, and maintain connections with 500 different legacy software providers.
To reach parity.
Just to get to the starting line. It is a massive, almost insurmountable barrier to entry.
Because it's the plumbing. And nobody wants to rip out the plumbing of a hospital if it's currently working.
Exactly. It's unsexy work, but it is absolutely essential to the system.
Right. So they have the tech, they have this impenetrable data moat, they have the integration moat. Let's look at the actual scorecard. How do they perform financially in fiscal year 2025? Because that's what Wall Street cares about.
It was a huge milestone year for them. They officially crossed the $1 billion revenue mark.
Welcome to the 3 Comma Club.
Exactly. Specifically, they hit $1.099 billion in revenue.
And what was the growth rate on that?
That was up 16.5% year over year.
Okay, 16.5% growth at over $1 billion in scale. That is very solid.
It is. But honestly, what's far more impressive to me than the top line is their profitability.
The bottom line.
Right. They posted an adjusted EBITDA of $462 million.
$462 million on $1.1 billion in revenue.
That is a 42.5% margin.
42.5% margin. That is huge.
It's truly elite. In software investing, we often talk about this heuristic called the Rule of 40.
Right, the Rule of 40. Just remind us quickly what that means for the listeners who might not be software VCs.
Sure. It's a quick back-of-the-napkin metric to judge the overall health and balance of a software company.
Balance between what?
Between growth and profitability. You take their revenue growth rate percentage, and you add it to their profit margin percentage. If the combined number is over 40, it is considered a very healthy premium business. It means they are balancing growth and cash generation well.
So let's do the math for Waystar based on FY 2025.
Okay, they had 16.5% revenue growth.
Plus the 42.5% margin.
Exactly. That adds up to 59.
59. So they aren't just passing the Rule of 40, they're essentially operating as a Rule of 60 company.
Which is incredibly rare at this scale. Most companies are either growing fast but burning cash, or they are highly profitable but barely growing. Waystar is doing both.
That shows just amazing operational efficiency. They are printing cash while they grow.
Exactly. And speaking of printing cash, let's talk about their capital allocation. What are they doing with all that money?
Right. Are they buying yachts for the executives?
Thankfully, no. They are incredibly disciplined. They actually converted 79% of that EBITDA directly into unlevered free cash flow.
So that's cash hitting the bank account.
$365 million in cold, hard cash generated in just 1 year.
And where is it going?
They are aggressively paying down debt.
Which is smart in this rate environment.
Very smart. Now remember, they just spent $1.25 billion on Iodine.
Right, which usually levers a company up significantly.
But despite that massive purchase, because they generate so much cash, they actually reduced their net leverage down to 3.x by the end of 2025.
That's pretty fast deleveraging.
Extremely fast. In Q4 alone, they dropped it by 0.4 turns. And their stated goal to Wall Street is targeting 1 full turn of debt reduction per year moving forward.
So they are marching toward a pristine balance sheet.
Yes. Financial resilience is a core part of the thesis here.
Okay, so let me summarize where we are at. We have a company that is growing double digits, highly profitable, sticky as glue, has a massive AI data moat, and is rapidly paying down debt.
All green flags.
So this brings us to the core investment thesis of our deep dive.
Right.
If everything is so great, why isn't this stock trading at the moon?
Well, there is a pretty significant market disconnect happening right now.
What are the multiples?
The stock is currently trading at roughly 16 times its expected 2026 EBITDA.
16x. For a Rule of 60 software company, that feels cheap.
The analysts think so too. Both Red Fox and Baron Capital have price targets around $38 a share.
And what's the upside on that?
That implies roughly 49% upside from current trading levels.
49%. So again, why is it so cheap? What is Wall Street worried about?
It really comes down to one word: the overhang.
The overhang. That sounds ominous.
It does, and it's a technical market dynamic, but it is absolutely crucial for any potential investor to understand so you don't panic when you look at the chart.
Okay, explain the overhang.
Before Waystar went public, they were backed by a consortium of huge private equity firms.
Heavy hitters.
Right. EQT, Bain Capital, and CPP Pride.
Massive funds.
Now that the company is public, those PE firms eventually need to cash out.
Right. They have to return capital to their limited partners. They can't hold stock forever.
Exactly. Their fund life cycles demand liquidity. So over the past year, they've been selling very large blocks of shares into the open market.
Through secondary offerings.
Yes. We're talking about 55 million shares hitting the market.
Okay, so it's a massive flood of supply.
Exactly. Basic economics. When that much supply suddenly hits the market, it puts a hard lid on the stock price. It physically cannot go up when millions of shares are being dumped.
So the PE guys are pushing the price down by heading for the exit.
Right. But here is the absolutely key interpretation that the analysts are highlighting.
Okay.
This selling pressure is entirely structural. It is due to the life cycle of the private equity funds.
Not the company.
Right. They're not selling because there is some hidden flaw with Waystar's underlying business.
They are selling because they have to sell, not because they want to flee a sinking ship.
Correct. If you look at the fundamentals, the revenue growth, the elite margins, the rapid AI adoption, everything is actually accelerating.
But the stock price is just temporarily suppressed by this artificial supply dynamic.
Exactly. And for a long-term investor who can look past a few quarters of PE selling, that often signals a very rare buying opportunity.
A discount created by technicals rather than fundamentals.
That is exactly the bull case for Waystar right now.
All right, so if we take a step back and summarize this entire bull case for the listeners.
Let's do it.
First, you have a completely mission-critical service. No matter what happens, doctors absolutely need to get paid to keep the lights on.
It is the definition of essential software.
Second, you have real recession resistance. If the economy tanks, ad spending drops, consumer discretionary spending drops.
But sick people still need care.
Right. The volume floor remains intact.
Healthcare claims processing is the underlying plumbing of a $4 trillion industry. It simply has to keep flowing, boom or bust.
Third, you have an AI leader that isn't just selling vaporware or cool slide decks.
They have $15.5 billion in proven ROI to back it up.
And finally, you have that Iodine acquisition, which completely closes the loop between the clinical reality and the financial billing.
They own the entire cycle now. It's a very, very strong combination of factors.
It's the utility company of healthcare, but powered by state-of-the-art AI.
That's a great way to frame it.
So as we wrap up this deep dive, I want to pivot to a broader, maybe slightly more philosophical question.
Okay, I'm ready.
We've spent this time talking about how Waystar is automating the provider's side.
Right.
They are using AI to make the claims perfect. They are basically arming the hospitals with AI agents to beat the insurance companies at their own game.
That is exactly what they are doing.
Here's my provocative thought for the listener to chew on today.
Let's hear it.
If Waystar achieves this vision, this truly autonomous revenue cycle, where every single claim sent by a hospital is mathematically perfect, undeniable, and backed by clinical DNA,
Right.
what happens to the insurance adjusters on the other side?
Oh, that is the billion-dollar question for the next decade.
Right. I mean, does this technology eventually force the payers, the massive United Healths and Aetnas of the world, to automate their denials even faster?
They almost have to.
Are we heading toward this bizarre future of an AI versus AI war for the healthcare dollar?
It is very, very likely. You can easily imagine a future, maybe 5 years from now, where a Waystar agent on the hospital side submits a massive complex claim.
Okay.
And instantly, a United Health AI agent on the payer side receives it and reviews it.
And they just battle it out.
They battle it out in milliseconds. They argue over clinical data points, negotiation protocols, and complex contract law in the cloud.
Without a single human being ever seeing the bill.
Completely autonomously.
War of the bots, fighting over your appendectomy bill at the speed of light.
It sounds totally dystopian, I know.
It really does.
But honestly, it might actually be far more efficient than the nightmare of fax machines, lost mail, and 2-hour hold times we have today.
I mean, it couldn't possibly be worse than the fax machines.
Well, let's certainly hope not.
Well, that is definitely a lot to chew on. From the $500 billion headache of manual billing to the autonomous AI agents of the future fighting in the cloud.
It's a massive shift.
Waystar is definitely a company we are going to be watching very closely as they fully integrate Iodine and continue rolling out these AI agents.
Absolutely. It is just a fascinating case study in modern software economics and finding moats in unsexy places.
It really is. Thank you for listening to this deep dive on Waystar, and as always, for you listening, risk define.
Portfolio protected.
We will see you on the next deep dive.